episode of The Independent Mindset, the podcast for candid conversations, staying curious, and simply being better. In today's episode, we had the pleasure of chatting with Khaleel Urrahman, financial advisor at Sun Life Financial. Born and raised in India, Khaleel eventually decided to start his life in our quiet part of the world, specifically in Moncton, New Brunswick. During the episode, we chat about what the Canadian winter is like for new immigrants, the difference between good debt and bad debt, what type of insurance you should have at what age, and the importance of networking and volunteerism. Enjoy.
All right. Well, Khaleel, thank you very much for joining us today.
Oh, happy to be here.
I was looking forward to this one all week there. You, my friend, have a very fascinating story that I think is worth sharing. And I would love if you could give us a little bit of your background and what made the man.
That's a long story, but I'll keep it under 2 minutes then. So I grew up in a small town near the Arabian Sea in southern India. Just like everybody, we have 5 kids in a family, mom and dad. Went to school, have a degree in finance, worked in, finished school and went to a big city, like everybody looking for work. Found a job on my day one in the big city, and turns out it's a Canadian financial services company. Didn't know a thing about them before. All I wanted was a job. So I was there for 2 years, and then my twin brother and I decided that we wanted to see the world. So my dad helped us with securing a bank loan. There's a long story there too, but anyway, he made an impossible thing worked out. So my brother and I went to New Zealand. I did my second degree in finance, and that was the main plan. And then in the meantime, somebody that I met in India, my life partner who's from Dieppe, got a job in the Philippines. So I finished school, didn't wait for my graduation, went to the Philippines, networked with the same company from Canada, and then got a job there. Worked for about 3 years, mostly in the corporate side. It was mostly corporate advisory services. And then finally decided to move to Canada just because we wanted a home base. No other reason, really. And then I've been here 11 years. First couple of years were rough. You know how it is. Like when you're in a new place, you're still looking for your network and trying to belong somewhere. And then I'm going to say it probably took me 2.5 years before I said, okay, I need to get back to my finance field. And I ended up meeting somebody at a house party who happens to be the regional vice president for Sun Life Financial. And he said, he asked me, what do you do for work? And I said, I'm just looking for something new. And then the conversation went from there. And you asked me a question about networking earlier. This is how it has been. Always. Everything starts with the conversation.
Right.
And sorry, go ahead.
Sorry, I was just gonna, before we get too far, I'm always curious of, especially folks who come from very different climates, how you found your first few years or winters, especially in a place like New Brunswick, Canada.
You know something, the first day we arrived, it was like 17th of December. I woke up the next morning. It was white everywhere. And I remember thinking, wow, this is like Narnia.
Yeah. But for someone who's never really seen or lived in snow, absolutely, yeah.
Exactly. So I basically sent an email to all my brothers and sisters, my mom and dad and everybody, and I put in subject line, bonjour, and like all that good stuff, like all the stereotype of a brand newcomer. And I took photos and stuff like that, and everything was fantastic, and I loved it for 2 weeks. And then I had made plans to go for a movie, and my friend called me and said, we have to cancel the movie. And I'm like, why? Because there's a snowstorm. Then you realize, okay, this is not just pretty. Like, it comes between your life, right?
Oh, yeah. And it's hard work when you're shoveling.
Exactly. So, I mean, to be honest with you, I quite enjoy the winter. I've come to enjoy it quite a bit. Still not to a point where I want to get away from it. It's not too long. I think it's like 3.5 months, whatever.
Yeah, it's like the transition in and out of it. I find as a an adult, the only thing I don't really like about winter is cleaning off the car.
Right.
That's
Yeah.
the only thing that gets under my skin.
That's not fun. Sure.
But other than that, I don't know. To me, I've
Yeah.
always loved winter. Like I remember Willie and me as little guys would go make
Oh
snow
yeah.
forts and have snowball fights and that sort of thing.
Yes.
And
Climb the shed, the roof of the shed with my dogs.
exactly.
Funny.
Yeah. The,
So
the big the big tip I give people to survive winter, people who are always like, I could never get used to winter, or I just hate winter, is if you don't have a sport or a specific activity you do in the snow,
It's
you're going to find winter a lot harder.
for sure. For sure.
Yeah.
And there is I have to tell you, there is something that everybody learns who don't know how the winter can be, right? I remember I was in Manila, and two guys were from Atlantic Canada in my group, and they were talking about -20, -25, and I'm like, okay, come on, like that's just not possible. Because in my tropical mind, I'm thinking, I was even arguing with them. I'm saying 0 degrees is freezing point. There's nothing below that, right?
Yeah, you're
Zero
thinking
Kelvin.
you're thinking 0K.
Exactly. So we're laughing about it. They laughed at me, and then we moved here. And I think the first week I decided I want to go for a walk, and you realize it's basically it looks like it's a sunny day. So I'm thinking, wow, nice, perfect. It looks great. I'm gonna go out for a nice walk.
The sunny ones are the harshest ones, Khalil.
And then you realize that's what it is.
Yep.
You walk out, and I think I took 10 steps out, and I realized I think my ears were gonna fall off.
Yeah, your nose hairs
Oh
all crinkled
man!
together. Your
I was
eyes water.
thinking, no, there is no guide where it says don't go out on the day, thinking that it's on the sunny days. Hilarious,
it's definitely trial by ice there if it's your first time around.
for sure, for sure.
Hey, do you connect with a lot of the newcomers still?
Yeah, I do. Now it's mostly like in social events and stuff like that. There used to be a time when I used to get random messages from people who are moving to Moncton, and I would help as much as I can because I remember being brand new, right? So,
So you work for Manulife now, and what is for the audience here? What's your current title, and what are kind of your day-to-day responsibilities?
so I work with Sun Life. Manulife is a different company.
Oh, sorry,
Um,
Sun Life. Sorry, did I just say Manulife?
yeah, that's all right.
Yeah.
There's so my official title there is financial advisor, right? So, but I've always told clients that it's like there's no way to really describe it other than like I'm like a doctor for finance. So whoever is in front of me, I have to figure out like what's going on, right? Where they are in life, what the way of the future is, build a plan, keep it up to date, and provide advice. And that could be anywhere from starting with some like budgeting, even sometimes budgeting to retirement planning to estate planning. There could be anything in the middle. If it's a business owner and they have corporation, employee benefits, there's too many pieces in there. So first, what I'll do is my first meeting, I basically take a snapshot of where they are, and then you identify what are the areas that they have to work with. If it's a individual, if it's a family, what's the right structure for them, right? And it's fun. Like for me, it's like solving a puzzle, and it's amazing.
I've never heard of it put that way, a kind of doctor for finance, but now that I'm a little more familiar with what you do, and that's really what it is. One thing I was wondering, like, I know it's hard to generalize with a topic as broad as this, but on a scale of, say, 1 to 5, 5 being the highest, how financially literate and how financially responsible are the general public, would you say?
Mm.
So that's a very tough question to answer because when we say general public, there's different groups of people in general public. So if we're going to put everybody together, I would say oof, two and a half, if that.
So halfway there, halfway there.
Yeah. So it's nowhere near where it should be.
And like here in Canada, we have a few tools like RRSPs, TFSAs. Savings accounts really don't do a whole lot anymore. Like what do people come and talk, like, say, just your typical employee, not a business owner, not
Yeah.
someone who's on that level, just someone who works 9 to 5, has median income sort of salary, in the 50 to 70,000 range.
Mhm.
What kind of problems are they approaching you with typically?
So there's a lot of, depending on if it's like mid 20s, there's a lot of conversation on student loan debt management before we even talk about building assets. So most of the time in that age group, we're focused on debt management and protection. And then it evolves into, okay, once you transition from debt management, then you go into asset building. Some cases, like, it makes no a lot of in a lot of cases it doesn't make sense to save money while you're bleeding interest on the other side on debt. But the unfortunate part, I think, about Canadian system is there is no financial education early on,
Mhm.
whether it's in
Yeah.
post-secondary or university or anything. But here's the problem: when clients come to see me, they're almost sometimes, if they have some debts, they feel like they should have known it. But the reality is nobody's ever given them tools, so why should they know?
Sorry, Khalil. I was just going to add, Jason and I, we did a recent episode on basically, is university worth it? And we were kind of weighing the options of university, all the different types of degrees now, versus kind of college or going straight into the workforce, and the debt behind going to university, right? And one thing we both kind of really chatted about is there is nowhere in high school even where we learn what a simple, like, what taxes are, why we're taxed, what are interest rates, what's a TFSA, what's an RSP, what are investments, what are stocks, what are mutual funds. Just these basic things we're not taught anywhere in our public school system, which I think if everybody in grade 12 got one basic class, I think you could up the GDP of the country just from doing that. But
And I'd like to go backwards, even like the basics, like budgeting, for example, or I think that's where it starts. Like, if you're going to have limited income, your expenses have to be limited, and you've got to know how to, balance your books, so to speak, right? If you're in the hole every month, where does it come from, and what's it really costing you to be in the hole every month?
So are people living above their means generally?
Some, yes, but there's been, I think it changes when you have the conversation, but a lot of times, in general, I see there's average people will carry debt.
Okay.
right.
It's not the average people are not debt free.
And you mentioned your, I guess, your youngest demographic are students, and you've been talking about, for them it's not about looking down the road in terms of investments or things like that. It's really how to manage their debt and move forward after that. I've been hearing that in the U.S. right now. I know it's a bigger deal, but that it may be one of the main contributors to the next kind of financial crash or crisis is just the accumulated student debt across the country. In Canada, is that, and I know you're not, you haven't seen the entire country or studied it, but from your impression, what do you think, how dire is the kind of student loan and debt situation in Canada?
I think it's pretty awful, to be honest, because like when students come out of university or whatever, like they've gone to school, for the first 3, 4, 5, 6, 7 years, you're paying your student loan off, which is unfortunate because you're in the negative for the first so many years. So, like, when we look at financial planning, majority of the time it's only being done for one generation. So, as I'm meeting clients, I'm trying to coach. If you can plan for two generations, your children don't have to go through the same struggle in their 20s. They can get a head start on their life. It gets better, right? There's really new immigrants are very, very good at planning for multiple generations. very good at that.
Yeah, I can see that.
So it's funny. Like earlier, I want to go back to the earlier question, like about general public, right? So there's key components in planning process. You have this people that have the tools, and then you have the people that have the skills. So when the new immigrants come in, they come up with the skill of how to save, living within their means and stuff like that. But they've no clue how the Canadian system works. What's a CPP? What how like taxes are done, and so in their mind, I want to pay as little tax as possible. So but you also want the free healthcare. See, it doesn't work, both ways, right? On the other side, the local Canadians are fully aware of, they've heard the terms RRSP from their parents, and you know all those things. But on the other side, the skills to manage household finances is not strong, right? So it's not all like that. When you look at a general population, that's generally how it falls in the categories.
And if you start with debt in your say mid 20s, well, you're by definition delaying other things. So family formation's most likely going to come later. Your
Yeah,
starter home's most likely going to come later. All these things are kind of pushed down the road. So you might you're setting yourself up to have a harder time
yeah.
to achieve what might be your goals.
Yeah, and like some of the mid 20s are very fortunate that they have parents that could co-sign for a house, or things like that. But that's not the average, right?
So if someone comes to you and says, Khalil, I want to build wealth, you're a financial advisor. Can you set me on that track? Is your approach typically to take the snapshot, take their balance sheet, find their income statement essentially, and then is it usually debt elimination, kind of base savings, and then you start talking fancy investments?
Yes, that's generally the idea. So the first thing we look at, like, have a will, power of attorney. Like, that's basic. Everybody should have that, which is hilarious because everybody should have it, but only a few people have it, or it's a
Guilty.
Yeah, I'm guilty of that.
Yeah, I think we're both like,
and then you've got to make sure you're well protected, because otherwise it's gonna send you back years and years if things go wrong with your health. So it has to start with protection and debt management. So if it's like bad debt, if it's not asset backed debt, then attack that first.
Could you define that a little bit just for our audience? Like, what's the difference between good debt and bad debt?
So any debt that is backed by an asset that can be sold to pay off that debt is generally a good debt. So
Okay.
let's take an example. You have a house and you've got a mortgage on it. It's certainly a good debt because you have an asset that you can sell and pay off that debt, and there's participation in capital gains. That's solid. An RRSP loan is a good debt because you've got the actual RSP money sitting in your RSPs, hopefully investing and doing well. But worst case scenario, you've got there's asset and debt together. Bad debt would be like consumer debts or credit card debts, line of credit, anything like that, where you went and got yourself a heat pump. You can't pull the heat pump and sell the heat pump to pay out the debt, right? So there's all of those like consumer debts, um, that I would say is bad debt, and these are all high interest rate debts anyway. In credit cards are at 19.9%. It's ridiculous.
Jason and I were looking at credit card debts again for another podcast a long time ago when we were talking about kind of taxes and the origin of taxes, and the average household debt in Canada, like just credit card debt, is insane.
Yeah, is it
Like we're one of
20,000?
the,
I think it was, something like
I think
that.
we're one of the worst in the world, right, in terms of credit card household debt.
I think consumer debt in general were the of the developed nations were the most impoverished by consumer debt.
uh, I'm not surprised, really. Yeah, like we're going back to talking about debt, and it's 19.9%, and it's just not acceptable to carry debt like that, because you're bleeding money. You work really hard for your income, and you're basically just giving it away. You can't become wealthy by giving money away.
So one thing, Khalil, you mentioned earlier was a will. What about insurances? I know it's really not as sexy as investing in strategy and crypto and real estate and that sort of thing, but what kind of insurances are out there? What do you do with it?
Okay, so everybody should have. There's five insurance products that most people should have. One, I'll go by priority. So you've got life insurance, critical illness insurance, disability insurance, health insurance, and long-term care insurance. So life insurance is straightforward. There's Well, it is and it isn't, because life insurance can get very fancy and sophisticated depending on the situation. But generally, the idea is if you passed away, there's enough money to pay off the debts. There's enough money for the funeral, final expenses, final taxes. If you want to create an estate and transfer assets to the next generation, you can do that. You can do that for income uh, replacement for your spouse or your dependents. That's that's generally the idea. You can do permanent insurance or term insurance. Term insurance is straightforward. It's good for a certain term. It's also very cheap. So if your need for insurance is $600,000 and your resources are limited, you're likely going to go towards term insurance. So at the end of the term, say it's 10 years or 15 or 20 or 30, it comes up for renewal. When it comes up for renewal, you're that many years older, so your premium goes up. Permanent, on the other side, starts off with a higher cost of insurance, but it's locked forever. So, one of the best things anybody can do is in their early 20s buy a growing permanent life insurance policy. Now, most of the time I give that advice, it doesn't make sense to a 23-year-old. Even to a
Yeah,
38-year-old, it does.
we're all invincible.
Yeah,
Yeah,
exactly.
And
Exactly.
yeah.
it's not attractive, right? You're not thinking, oh, I'm going to do these cool plays, I'm going to make money, and I'm going to get these assets. Like, how do you sell that to a younger guy?
Right, and it would have to be based on planning, right? Like what's coming in the next 2 years, next 5 years, next 10 years. And health is not something that can be guaranteed. So it's easy to simply do a term policy. It's cheap, 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 right? Difficult to do a permanent plan. A permanent plan can come in handy if you have maxed out your TFSA, maxed out your RRSPs. You could use that towards tax efficiency down the road for income streams. So let's not go too detailed in there, but generally there's a whole life or permanent or term insurance. Then you've got the critical illness plan, which is basically a living benefit, pays out one time in case if there was like a stroke or a cancer, whatever the benefit amount is gets paid out, and it's tax free. It can be set up as a temporary 10-year term, or it can be set up as a permanent plan where the cost is locked for the next, say, 60 years, for example. Then you've got the disability insurance, which basically is a salary insurance. Um, Now, there's always questions about like, should we do disability? Should we do critical illness plan? Both of them have a different role to play. If it's disability, it's literally protecting your biweekly pay. It's critical illness plan, it's protecting your assets that you're building or protecting you from going backwards. So if, let's say, in your 30s, you've got a major health crisis like a stroke, which is becoming more and more common, unfortunately, you shouldn't be in a position to liquidate your assets. Your insurance should protect your assets, right? Disability will make sure that your income is continued till age 65. A lot of employers provide disability insurance, but there's always opportunity for top up and to read the documents with the group insurance. Usually there's like a 24-month period where there's a evaluation of can you perform any other jobs, and that could get tricky. Health insurance, everybody knows what that is. That's for medical claims, paramedicals, dental, vision, stuff like that. A lot of employers provide it, but here's what we have to think about. What happens when you've used your group coverage until you're 60 years old and now you're retiring and you're trying to get yourself a personal coverage, but the last 40 years you've been using all the group benefits?
Yeah, it's going to
Every,
cost you an arm and a leg.
in fact, most of those will be excluded as pre-existing conditions. So, like that is part of the discussion for ongoing, depending on which province too, because some provinces have a good provincial coverage. And then you've got the long-term care. Think of long-term care as disability in retirement. That's the best way I can describe it. So either like you've lost the ability to function on your own, or you've lost your mental capacity, like if somebody has dementia or Alzheimer's and things like that, where they're completely dependent on another person, that the insurance comes in handy rather than having to pull all the money out of your assets. Because that the assets can go out the door very quickly when you're in a situation like that. So that's like, I'm going to say those are five insurance products most people should have. But when I'm planning, I'll take a look at what's provided by the employer, what isn't, and life and critical illness should always be your own. Should never be dependent on the employer provided benefits.
And Khalil, what are the, well, actually, first of all, just sidebar, did you say strokes are going up?
Oh yeah, like you've lower age group,
Really?
cancer, stroke, heart attack. That
Huh.
used to be like 50s with the high risk category, not anymore.
Okay. Yeah. So it's affected your actual categories. Huh.
Yeah.
And my question was going to be work. What does work? Again, it all depends on the company, or if you work for the provincial, the federal government, for instance. But typically, what are the insurance that work covers, and that you would encourage folks to get on their own?
So most group plans have a life insurance and accidental death that's built in. That life insurance should everybody should have their own. Doesn't matter what the employer is providing. It should always be your own. Um, very rarely I see a group offering critical illness plan. Um, but disability and health plan are the two most common ones that group provides. And so for the group, for the disability, everybody should look at what's the percentage of income that is being covered in case of disability, how long the coverage is for, and is there any opportunity to top up and get the maximum income replacement in case of worst case scenario.
And say someone's on just below median wage income and they don't have a whole lot of disposable income to play with. Uh, if let's say they have kind of the basics covered with their plan at work, what's usually the first one that you go take a look at once you kind of got, say, critical illness and life insurance in the bag?
I'd say disability, income
Okay.
protection. I'd even look at income protection before the critical illness.
Okay, because you're thinking, I'm trying to take your rationale here. You're protecting the person's income,
Yeah, and without the income, there's no plan.
right?
Right.
That's essential, right?
Do you when you talk, because we've covered so far kind of insurance and debt management, that kind of stuff, as you are a financial advisor, do you ever have to deal with people that are quite emotional? Does like, do meetings with clients become tense or difficult in that sense?
For sure. There are times I'm a therapist. Sometimes I'm a marriage counselor. Sometimes I'm a coach. So yeah, it's a very interesting business because money is tied to everything. Your relationship, how you look at yourself, how you think that others look at you. It goes deep.
Do, do you ever look at say coaching for, and I know this is a little bit outside the scope of financial management, but like retraining to get a new skill? Like, do you ever look at someone's portfolio and say, like, you just need to make more dollars?
Yeah, man, absolutely. And I've always said like there's three ways you can increase your income, cut your cost, or use somebody else's money. You do all three, you're three times ahead.
True.
So there are times I would say, okay, like these are your plans. You've got to bring in so much of income. Maybe it's through Airbnb a second, second room in your house, or simply getting a second job.
And how do you use someone else's money?
So you could utilize that if you have a rental property. That's the straightforward one. You could live on one unit, rent the other out, or rent the other four out, whatever the case is. You can utilize RSP loans, for example. So you're basically borrowing and putting a down payment on your retirement, paying off the RSP loan slowly. Usually, RSP loans are pretty cheap, and you invest differently, so you're making more. Plus, you're getting the tax return. So use the tax return to offset the debt from the start. So you're paying less on the debt and potentially making more on your RSP. All depends on your investor profile too. Like if you're an ultra conservative investor, that would be a tough strategy.
Tough sell, yeah.
Yeah, and that's when you start getting like a little bit more fine into the nitty gritty of, how can you offset or how can you minimize your tax burden? How, and like whenever someone I hear someone say borrow against your RSP, like I immediately close off. I don't know why I have such a mental resistance to that.
Your butt just clenches a little bit.
Just a little bit. Like to me, RSP is just throw dollars in there every week, and then we'll talk when we're 65. Like, how do you get people over that mental hump like me that are just like old sticks in the mud?
Okay, so I'll give you an example. So let's just fast, like go backwards, and let's assume that we're in February, and let's say we are talking, and then you've got a $3,000 credit card, and you've got nothing in your RSP, and you make about $75,000 a year. So your marginal tax bracket is in its 30s, right? So
Right.
35%, I think.
Right. Yeah. Somewhere's around there.
Okay. So wouldn't it make sense, instead of putting all the money towards the credit card, you go and get yourself an RSP loan, generate a tax return, use the tax return to pay off your high interest rate credit card. And now you've replaced uh, a bad debt with good debt.
Mm.
It makes sense, right?
And it's a good debt because now when you pay back that RSP loan and presumably keep on paying into RSPs, you're lowering your tax burden.
Now, let's assume that you did it once, which means your RSP is growing, tax deferred, and on the other side, you're paying off a very low cost debt. You went from 19.9% down to 3.45%.
Right.
So
So you're
that's
not
a
losing
16% gain right there.
right? Like it's a big win. Overnight, you changed your financial structure. So that
Yeah.
works. Like there's products everywhere. My job is really to look at how do we turn them into solutions.
So you mentioned one of the ways to up your income is to get money from other folks, and I believe you're also in the real estate business, kind of a little bit like Jason, I guess. Whereas you have some tenants. So can you talk a bit about that and essentially and also that as an investment?
So okay, so that's I think everybody should have a little bit of fixed asset in their portfolio, whether it's their primary residence or an investment property, but something. And real estate has been a solid fixed asset for eons. So when we wanted to get into real estate, basically we went and met with a bunch of realtors who did investment properties, but we also took a course. It's a 3 day, full day real estate university course, and lots of strategy came. We learned lots of new strategies there, and then we just went and started saving money for down payment and bought the first one, and then first one helped in getting the second one. Now there's a lot of things that I've learned since. So you could buy a rental property and you could do a purchase plus improvement, meaning take an old property, borrow for the improvement, fix it all up, and then now you have all the renovations done up front, and you've leveraged, banks' money for that.
And now you have the value added. In that case, there would you be looking at more of a rental strategy, or would for the cash flow, or would you be looking at a flip to have, say, a better down payment for a building that's ready to go?
Both strategies work. It all comes down to what do you want that fixed asset for. If you're going to hang on to it as this is my fixed asset for the next 25 years, I'm going to hang on to it, pay for it, and then sell it later on, cool. If you just want to flip it, you can flip it. Like, you can go either way with that. Of course, being in a seller's market is a major advantage, obviously, but it's not as much of an advantage when you're buying. But
Yeah.
it does give you some advantage when you're selling.
Right. As long as you have another roof over your head that you can go to.
Yeah. You could also refinance and pull all of your down payment if you've done a great job, or if there is like a major uptick in the market and you've got a capital gain in a year. You could refinance, pull all the money out that you used, and you put it towards another asset if you want,
Right.
which is kind
And
of what's happening in Moncton right now.
Yeah, that's definitely what we're seeing here.
Yeah.
yeah, we just interviewed a real estate agent here in Ottawa, and pretty much every market across Canada is absolutely bananas right now.
Yeah, and it's not just Canada; it's happening all over the world. The bigger centers, people are liquidating and moving to the smaller centers, offering cash, over asking. Like, so it impacts the smaller markets much bigger than it does the bigger markets.
And even than that, we're not really seeing a price depreciation in the larger centers. It seems like there's somehow still demand to keep those going.
Yeah, because we're only getting the overflow.
Hmm.
Yeah, we were the real estate agent had mentioned like Toronto, the Toronto area. There was a bunch in the last few years. There's been a bunch of people coming from the GTA into the Ottawa region and just overbidding everybody because they had the big city money, right?
Ah, right on. So I bet you people from Ottawa are coming to Moncton and doing the same thing.
Yeah, probably.
Hey,
Now
Khalil.
that you can work virtually.
Yeah,
Well,
exactly. And that's
well,
what's driving a lot of this, I think.
Yeah.
I would say so. I know I was speaking with some people coming to Moncton, and it's exactly that. She works at a university nearby, and he's an accountant, and he can do all of his accounting from home.
Yeah.
Hey, Khalil, one thing I really want to ask you: you gave us the quick synopsis of your journey at the beginning of the show. How do you go about building a clientele in a brand new city where you know your partner and your new boss?
Oh, good question. You just have as many conversations as possible and you gravitate to places where there are people. You volunteer, you sit on boards, you provide a service to the community that you live in, and then do a really good job for every single client that you come across.
So just talk, 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 and work your butt off.
First couple years is like building that network is equally hard as finding a new job, or like I find building a network, we never really stop. We're constantly networking, and I think every conversation is networking, basically. Right? If you are a self-employed person and you have a service to offer, and you're having a conversation with somebody at Tim's, for example, you're literally in front of 10 of their network. So you don't do if you don't put the best foot forward with every conversation, indirectly, invisibly, your networking ability is shrinking.
Right, because you're closing 10 doors, not just that one door that you're maybe having a subpar interaction with.
Yeah, exactly.
And for those people that are introverts or just not naturally good at networking or selling themselves or just starting a conversation with someone, do you have any kind of tips of how someone should go about starting to network if they're coming from a new place for instance?
I'm to me, like when it's like that, I totally use uh, virtual platforms like Facebook and LinkedIn and whatever else is out there.
Right.
I would
The,
probably engage digitally. For somebody who's an introvert, it's a lot easier to have those conversations digitally than it is face to face.
this is true. I'd argue one of the only nice byproducts of social media.
Yeah, for sure. But and networking is again like I think sometimes when we hear networking, it feels so fake and superficial. But the reality is, I think networking is literally that connection we have with another human being, and it just grows from there.
That's definitely one thing I'm noticing too, being in a management role now, where everything is sales, but everything comes down to people.
Yeah,
If you speak to people the way you would speak to a friend, you just treat people like people, as simplistic as that sounds, it really goes a long way to add influence, but really to add value to the interaction. And if you're adding value and you're doing so in a genuine way, people are all just seem to naturally want to gravitate to whatever you're doing to give you a hand. Like in my case, it might be, what I'm asking the employee to do. In your case, it might be getting you the referral to your next client.
right.
So yeah, so in that case, there, did you mainly just go like when you say committees, is it just like local things? Like, do you join the SPCA board, or what'd you do here?
A church?
I worked with the Pride Committee for a little while. I worked with the Boys and Girls Club of Riverview. But I also did like volunteer work at the food bank, at the magma. Like so, there's like places wherever there are people. Let's just say
Yeah.
is where I was.
And that's a that feels like a win-win-win to me, right? You're networking and hopefully increasing your odds of financial and professional success, but at the same time, you're feeling great because you have this purpose as you're volunteering, and then thirdly, you're actually volunteering and doing giving your time for some great causes.
Yeah, and do you know what? When I became a Canadian citizen, one of the things that they talked about was when you become a Canadian citizen, you have a privilege to volunteer your time. So use it. Like, please give your time to the
Hmm.
community. It's it's so fundamental to being Canadian or whatever country we live in, right? But I feel that's a fundamental privilege.
Yeah,
Yeah,
living
that's
so
beautiful.
well that you can afford to give some time.
Yeah. And
Yeah.
you know what? You actually meet people who are doing the same thing. And then you're in this happy zone all the time when you're giving. And
Yeah,
you feel good.
agreed. It's rare that you're volunteering, and like yes, it depends what kind of volunteering for sure. But whenever you're volunteering, let's say at the food bank, it's not like it'll make you be in a bad mood. You're just doing nice things for people.
Absolutely.
Yeah, yeah. So I have one last question for you on my end, and that's, do you have, essentially, if someone was going to ask you what should your investment portfolio look like? You mentioned a bit of, um, we could talk about RSPs. We could talk about if you're trading with stocks yourself. You talked about having a hard asset like a house or a few properties. So if you kind of had to narrow it down into, or simplify it into percentages, what would you say a healthy portfolio looks like for someone who's not necessarily rich, of course?
So it'll come down to an individual, right? So you take a look at, how they should be investing based on who they are. So if they are, somebody who is conservative, it's difficult for them to own stocks of their own or, to own a property because as much as real estate is, can be passive, it can also cause a lot of heartache. You could have one tenant that could just, ransack your house. And it's tough. So the mutual funds, the seg funds, the ETFs, the index funds, whatever you call it, like that's majorly like a passive asset that can people can invest in. So I don't know if I could really truly answer that question about the percentage. I think it needs to be what type of asset class first. That's what it should be. Like if it's going to be a stock portfolio, mutual funds, anything like that, and that's where the comfort zone is, then within the asset class, you look at should you have 60% equity and 40% fixed income? Or you look at the overall asset class and you go, okay, I want 100% equity in my liquid assets, but I own one fixed asset, some outside the mutual fund portfolio, for example. So that's a tough one to answer. Um, and investing too is not everybody is thinking about compounding. Not everybody is thinking about what the a small contribution in your 20s is going to look like in their 60s, and to even see
Right.
the impact, right? And there's no, it has to be up to date. The thing is, you can't have one asset class and keep it for 40 years. It has to be reviewed, whether any asset class it is. So that's a tough question I find you just asked me.
You stumped the doctor.
Yeah.
Khalil, I got one last one for you too.
Sure.
Um,
I've got a
what?
couple of other things to say, but yeah, go ahead.
Oh, sure. Go right ahead if you got them.
No, see, as much as we talked about people in their 20s, and that's just one. So there's usually three groups of people in my clientele. So you've got the 20s and the early 30s, that's one category. The other one's the 40 to 65, where they've become really serious about saving money, retirement planning, paying off the debt, like the freedom. And
Boomers.
um, there's the people who have already retired, and their focus is to make that money last long, but also transition some assets to the next generation. So there's uh, different way of planning for different groups of people. Now, on there's a new category of people who are in their 20s, they want to be retired in their 40s. Amazing group of people to work with. They're well informed, they're great savers, they have goals, they're driven, that group is getting bigger and bigger. I'm very, very happy to see that.
Is there a danger associated to that group? Do you see kind of lack of consumption or say lack of contribution in traditional asset classes? Do you see that depressing like the economy in one way or another?
I find so this is when somebody goes on that minimalist mode and putting away as much as possible, this they're not necessarily considering the evolution in life. Like going from buying a $15 t-shirt to a $75 shirt. And so when they're planning for wealth, they're always looking at what the current lifestyle is. That's the danger I find. So it's the consumption is minimum, money is like they're asset rich, but they go without.
Okay, so they're not necessarily thinking like I might have a wife and kids and I am going to have to fork out more dollars at some point.
Yeah, that and living on a certain budget forever, like that's not realistic,
Right.
Yeah.
Because
right? Like
Yeah. We're
there's
you're
no
go-
room for growth, personal growth, passion project, a hobby, travel, things like that. So it's a that's the danger zone.
so you kind of take the
I
life out of life in at that point.
Exactly. That's
I
exactly
always
it. That's exactly it.
yeah, the living out of life. But I also look at it from a actual physical perspective, because you have like things like the tiny house movement.
Yeah.
And I always think like that's nice, but I just don't know how sustainable that is depending on, what the next 10, 20, 30, 40 years look like for you. Or is it just a fad? And it does seem like it is the case for a lot of folks.
Do you know that's such a I don't I personally cannot relate to it, but I know a lot of people who are totally drawn to a tiny house.
Well, it's attractive, right? It's cute. Like the photos of the tiny houses, they're always on a mountainside or a beach side, right? They're never parked like in a trailer park where you kind of there's already tiny houses in the world. They're called trailer parks.
Yeah,
Yeah, it's
exactly.
true.
Exactly. These are high end, like posh places, right?
Yeah, and they
But
always look
it's
sleek
I
and
think these are
modern. Yeah.
all like these are all things that look attractive, but they're not permanent. I think if anything, imagine two people trying to work from home because they can, but it's COVID, they can't go anywhere, and they're in a tiny home. Ooh,
Yep.
that's attractive, right?
Yeah, I'm going to my room.
Yeah.
Hi.
Yes.
Yeah, exactly. Your room is the bed with like the half ceiling
Yeah.
wrecking your face all the time.
I've
Yep.
always wondered, like, how do these couples have sex? Like, seriously, you have like 1 foot of headspace above you. Like, you're stuck one way the whole time.
That's kitchen counter, Jason.
Every tiny house I see, I'm always like, you got no room to play. Like, what are you doing here?
Yeah, it's true. The beds are always in the loft there where there's like a couple feet for you to crawl into bed.
Exactly.
Listen,
Yeah.
Jason, not everybody is like 6 foot something like you.
Hey, man, I take space. All right.
Yeah, you're talking to the wrong crowd. 6'1" and 6'3" here.
Oh, yeah, perfect.
Hey, Khalil, the last question I had for you. What about cash? Like right now, we're kind of expecting
Mm,
inflation to run wild. How much cash does someone have? Is it kind of like
yeah,
the
good
typical
question.
like 6 months worth of an emergency fund, or you just keep hoarding cash? What do you do with that?
Well, so that's so again, it'll come down to investment strategy. So if the goal is to wait for the next sort of a dip in the market, despite of whatever the asset class you're investing in, definitely a good strategy to have some cash. But you'll have to decide if it is like a cash for the sake of having a backup. 3 to 6 months is solid. If it is for investing purposes, offset, it will really come down to what the investment amount would be. Like what's the like if it's an asset class, like a real estate, for example, and if wherever you are in Canada, say if it's a buyer's market, and you're thinking like the price are falling for whatever reason, you'll have to figure out what's the 20% down payment that you need to have.
And then just work towards that.
Right. You
It,
can't pull money from your RSP, so it has to be another source, maybe your own house equity or your cash.
that's kind of the camp that I'm in right now. I like having the rainy day fund, the 3 to 6 month fund.
Yeah.
But then I like having the opportunities fund. So the
Yeah.
emergency fund is exactly for that. And then the opportunities fund is maybe I've been eyeing this stock and it just hasn't hit my target price yet. So I'm just accumulating the cash. It hits my target price right on, dump it in there or
Yeah.
dollar cost in. Or like you say, the next real estate deal, but I'm saving up for that next opportunity.
Right. So you can always go backwards in time and take a look at the historical performance. See when it's a dip in that particular asset class, how much is the dip? What's your line? And how often does it happen? If that waiting period is too long, why hang on to cash?
Hmm.
Because while
Right.
you're looking for the opportunity, you're missing out on the existing opportunities, right?
Right.
So it would be nice to have like millions sitting in there in your portfolio, and you can put say 10%. Actually, this is interesting. So if you look at a mutual fund portfolio, you'll always see 3 to 5% of the portfolio sitting in cash.
Yeah, always. It's just there right in
Yeah.
case, ready to go.
Right. So perhaps we can all learn from that and say, okay, 5% of the portfolio needs to be in cash.
And
Doctor
and
has
when
spoken.
and when you guys mentioned 3 to 6 month cash, are you talking 3 to 6 month worth of paychecks purely?
Expenses. Put all your
Net.
expenses together in that.
Okay.
Yeah, net.
Net. Okay. Gotcha.
So
Right on.
yeah, Khalil, that was a great shot. I know I learned quite a bit, and maybe I'll be less shy there to tamper with the old RSPs.
Yeah. So that's the thing too. So if you are think you have we have to think about how much money are we paying in taxes before we have the money in our hands.
The
So
answer is too many.
right.
Yeah, the answer is too much, whatever
If
it
Yeah,
your
too
is.
much.
marginal tax
Too much
bracket,
and too many taxes.
if your marginal tax bracket is 35%, then let's say, like, because there's a lots and lots of people who say, no, I'd rather do TFSA, I'd rather do RSP. There's different schools of thought, and depending on where they're in life. So say, for example, it costs you 35% to make money, and you put that into a TFSA. Until it grows to a 35%, you're in the hole,
Mhm.
right?
And even at that, if you're to take that after tax income of 65 cents on the dollar to go up to that extra 35 cents, that's almost a 50% increase that you have to make just to get back up to that $1.
Right, right. So it almost makes sense to take, like, do the RSPs, take the tax refund, put that into the TFSA. That, now you're like leveraging your own tax money, right? I
Hmm.
don't know how I ended up there, but okay.
Yes, that's right on.
More knowledge. It's all good.
So I
So,
mean, it's too bad. Like, no, we're looking at Canada in general, right? There's such a big correction going on in the real estate market. It's sad to see some of the people who should have owned properties are now priced out.
wait, hang on. You're saying this is a correction. Usually, when you think correction, you think a dip in price. So you're from what I'm gathering here, you're thinking that the market was undervalued.
I think so.
So it's
Interesting.
correcting to the upside.
Now, I don't know the story on larger cities, but I'm certainly commenting on our little market here. We were certainly underpriced for too long.
Really? Okay.
Yeah.
That's an interesting take.
So a couple of my friends bought a house in Fredericton and St. John 2 years ago, and they paid at the time probably 80 to 90,000 more than what it would have cost them in Moncton, and there's absolutely no reason for that.
Hmm.
So Moncton went for years and years and years undervalued.
And Moncton's the fastest growing city in New Brunswick by far now.
In Canada.
Exactly. Exactly.
Is it in Canada now?
Yep. Last few years, it's the fastest growing city in all of Canada.
Yeah.
Wow.
So the higher the population, and I don't think we're building enough houses in our region to keep up with the population inflow.
We're building apartments like it's going out of style, though.
So think about it. So if there's 2,000 families moving, or 2,000 households moving to Moncton every year, are we really building 2,000 units?
No, we're building maybe 600
Right.
coming
600,
live.
maybe 1,000. We still have a shortage, which means the price is going to continue to go up.
And that's assuming that those newcomers to the area want a two-bedroom apartment and not a quarter-acre lot.
Right. Right.
And that's also adding on the whole break in the supply chain right now,
Right.
which
And
will slow
that's
down the construction of anything.
exactly.
So yeah, use that cash wisely.
Yes. Yes. Use somebody else's money if you can.
Absolutely. That's the lesson right there. Use good debt.
Yeah, definitely.
So Khalil, where if anyone's interested in getting your services, where can they find you?
They can find me on my official Facebook page. I'm on My Sun Life website and they can look through contact your advisors in the region. I'm licensed to work in New Brunswick and Ontario. Um, I
There you
do
go, Ontario
only have
listeners.
a handful of clients right now in Ontario, but I think that number is going to grow in the future.
Well, especially with all the virtual work now, and a lot of our audience, actually, the bulk of our audience currently is in Ontario. So we'll be sharing all of your links on our episode description and on social media.
Oh, I appreciate that very much.
Well, Khalil, it's been a pleasure. Thank you very much for joining us today.
Thank you so much for having me. Next time when you talk about fashion, please ask me to come in.
Will do.
Oh, right on. Okay, good to know. Cheers.
All right, guys. Take care.
Thanks for tuning in, everyone. If you guys ever feel like doing us a favor, feel free to leave us a review wherever you listen to podcasts. If you especially liked a certain episode or topic, let us know on Instagram or share with your friends who you know might enjoy the topic. I know both Jason and I would really appreciate it. Until next time, cheers.